Good morning. It's great to be here. My alternative is actually in being in class in E62. I'm actually enrolled in MIT Sloan School's Executive MBA program. So I'm actually skipping school, I think, for the first time today. But it's actually worth it. So far, it's been a great talk. I'm really happy to be here. And in all seriousness, the way that MIT and the IDSS, you guys have approached these big problems by integrating these domains, I think it's really terrific. The timing's great to bring together a group like this. So let's see. So let me introduce myself and my company a little bit, and then we'll just touch on some of the areas that our risk group is thinking about. So Rowe Price, we're headquartered in Baltimore. We were founded about 80 years ago by Rowe Price in Baltimore. He was driven by a mission actually of reducing conflicts of interest between investors and their advisors and their portfolio managers. So we created Rowe Price, and we've had a pretty good run since then. Now we manage about $750 billion for investors around the world, mostly, although not exclusively, in long portfolios of stocks and bonds and currencies. The firm itself has trading desks in Baltimore, London, Hong Kong, Tokyo, and Sydney. We would be, and this may be obvious to some of you, but we would be considered the buy side of the industry. So all we do is we collect assets from investors, gather them together, and make investments on their behalf. Right? So we don't do proprietary trading. We don't hold stock and bond positions for our own company. So we are considered the buy side, as distinct from the sell side, which are the banks and the broker-dealers that do entertain leverage and do hold risky positions on their own books. It's an important distinction because I think you want sort of different risk management philosophies for the two different groups of firms. 100% of our client assets are held in banks, right? And so we are completely aligned with the notion of keeping the banks healthy. They're to protect those assets, and they're to be good trading counterparties for us and for our clients. But that said, and I think this will show up a little bit later in the talk, it's important to be very careful with how we keep those banks safe, right? So there's some potentially unintended consequences of regulation, and it's important to weigh the costs and the benefits of proposed regulation. Okay, so I am the CRO of Rowe Price. I've been at the firm for 20 years. I graduated from MIT, actually course 6, a long time ago, right, like Stephen. I've had a bunch of different roles in the firm in quantitative research and in portfolio management. I managed a group on the trading desk, got involved in all kinds of different topics. I got involved in risk management about 6 years ago. We take a very broad definition of risk. So we have one group, one whole team that's dedicated to investment risk, right? What can go wrong inside of client portfolios? Studying the stocks and bonds, doing the stress tests, looking at things like counterparty risk, the valuation of our securities, liquidity risk in securities lending, risk in the use of derivatives. What else? Our head of investment risk is here, David. So if I get any hard questions, I'll bring him into the conversation. The other piece of the risk management, which we won't really dwell on too much today, but it's all the corporate risk, anything that can go wrong for the company. So we do business continuity and fraud and enterprise risk management, capital and liquidity assessment for the firm, IT risk, kind of all the standard things that you would expect a financial firm to do. Okay, so now let's get into a couple of different topics that we've been involved in. So automated trading and transaction cost analysis. I picked this one, first of all, because it's kind of sexy and cool, but also because it really reflects how over the past 10 or 20 years, data and analytics have really changed dramatically the way that the industry works, right? So 20 years ago, most of the trades at Rowe Price and our peer firms were done by a trader picking up the phone, calling another trader, and negotiating a trade. And that has just declined continuously over 20 years. And what's been on the uptick is more electronic trading, right? A trader making use of electronic communication systems and other trading algorithms to get their trades done that way. And then more recently, what you've seen is an uptick in more automated trading. So I actually program the computer to, in a more robotic fashion, either generate the trades or certainly to execute the trades, right, based on what it's observing about market conditions, trade characteristics, algorithm performance. And so all of that requires extensive data collection and data analysis so that you devise systems that are doing the right thing. Just to be clear, I can't use the term high-frequency trading for Rowe, in part because we still have portfolio managers coming up with the trades, and in part because in those terms, our holding period is basically infinite, right? So, at least compared to high-frequency traders. So that's one where data and analytics and technology are really changing the risk profile of the industry. All right, let's get on to a couple of other examples where we've been busy lately. So money market fund reform, the topic has come up here a few times before, and I think a lot of you probably have familiarity with money market funds. So, but just to be clear, a money fund is a place where investors, both individuals and institutions, keep their cash reserves, right? So the money that they want to keep liquid. The sort of defining characteristic of money market funds historically has been that they maintain a stable price of the fund, right? The net asset value for the price of the fund of $1 per share. And that's intriguing because the market value of the investments of the fund are not always $1 per share, right? Because of interest rate changes and credit risk changes. The market value could change. It could be 99.9 cents or 100.05 cents or something like that. And so the risk arises because we maintain that stable $1 NAV in the money fund. If an investor redeems their assets out of the fund and gets $1 back, but the market value of the fund is only 99.9 cents, that alone can cause the NAV to further decline, right? Can create pressure on the NAV. It's an interesting incentive structure because it encourages investors during a time of stress to try to be the first ones out, right? We want to redeem early. It kind of creates this run on the bank type of situation for the money funds. And I highlight there, we did see that. Obviously, in 2008, we had a big, very significant, prominent money market fund break the buck, price below $1. And all that they can do at that point basically is close up shop, right? So they stop redemptions. They basically fold the fund up. They give investors money back, but not as much money as the investors were expecting to get, and certainly not as fast as the investors were expecting to get it. And so, and what do investors do at a time like that? They do sort of what's appropriate. They say, if that money fund had problems, I wonder what other money funds might have problems, and should we just take our money out of that asset class en masse? And don't forget what that money's doing, right? It's invested in government securities, T-bills, and commercial paper. It's sort of funding corporate America to a large extent. So it's kind of important what happens with flows in money funds. So the government stepped in, kind of supported the industry, I think very appropriately at the time, and subsequently introduced some regulation to try to make the industry safer, which is all good stuff. And so specifically, so we've been making some changes to our money market fund franchise, right, in response to that. A few things that we have to do. We have to sort of separate the funds so that we have certain funds for retail investors and certain funds for institutional investors. Retail investors in money funds tend to use them sort of temporarily to hold money in between other investments, whereas institutions are like the big corporates that kind of hold big balances, and we use the term hot money, right? It can move pretty fast in big disruptive chunks. And so then the other big change is that they basically say, okay, if you are a institutional money fund, and you invest in risky securities, then you really can't have that stable $1 NAV anymore. Right? You have to just have a fluctuating market-based NAV and kind of reduce that run-on-the-bank type risk. So we've been making all those changes to our franchise. We've been increasing our stress tests, right? So we study the money market fund portfolios to look at how they would respond to interest rate changes, credit deteriorations, redemptions, combinations of those things. I make it color. And we make sure that we have those analytics, sort of an early warning system for stresses in the marketplace, in place to provide our portfolio manager system insights, our risk managers insights, and then the fund board of directors insights. They have ultimate responsibility for the health of the funds. Okay, money market funds. Turn the page. Liquidity risk. And so this is a very important topic. And so what are we talking about here? I stole this slide. But basically, the green bar represents the growth in mutual fund and exchange-traded fund assets and fixed income over the past few years. So the green bar tells me that funds are a vehicle of choice for investors to get their fixed income exposure. Right? The blue bar represents dealer inventories in fixed income. Right? So the commitment that banks and broker-dealers have to holding inventory in fixed income securities, in part to facilitate trading for the funds and other investors, right? So they would be viewed oftentimes as liquidity providers in the fixed income space. So this is a little bit interesting, right? And it points to a potentially interesting future if investors were to take their money out of those fixed income funds and the liquidity environment were different from what it had been historically, that could feel pretty bad. So the SEC, one of our principal regulators, I think they're in the room somewhere, so honestly, I appreciate all the work that the SEC is doing, and I actually, in our comment letter, we commend them for looking at this topic. I mean, it's an important topic to look at. It's interesting for a bunch of reasons. In part, the banks and broker-dealers reducing their commitment to holding inventory in fixed income could be traced to other regulatory changes, right? So from other regulators. So But in any case, in the response the SEC provided to the fund industry is a proposed liquidity rule, right? Which in a pretty prescriptive way instructs fund companies on how to analyze liquidity in fund portfolios. Requires a lot of data, requires a lot of analytics. But in much the same way as we did for the money fund franchise, it allows us to compute insights into the portfolio and then to provide them to the investors, our portfolio managers, and our risk managers and the board of directors. And then there are some requirements on holding certain assets in certain liquid vehicles to make sure that the funds are adequately prepared in a stress scenario. So we've been responding to that. Been spending a lot of work on liquidity risk. We did write a comment letter to the SEC on the proposed rule. We think that the rule, as written, again, complementing, looking at the issue and trying to raise awareness and make the system safer, try to head off or mitigate the impact of a future crisis. So that's all good. But the rule was quite prescriptive, right? So it had sort of definitions of 6 different liquidity buckets that all the securities would have to be classified into. And it's a little bit onerous, to be honest, right? So we actually have done liquidity risk management analytics for a very long time. First, because it's healthy, right? It's a good thing to do. It's important to do, right? Part of being good fiduciaries and good investment managers is being good risk managers of those assets. And also because we have a European fund franchise and the Luxembourg regulator actually has required this for years. So part of our comment letter was a suggestion that the rule be less prescriptive and allow us to sort of figure out the approach to take, right? Maybe with some parameters, but hopefully we can come up with an approach that satisfies both the Luxembourg regulators and the US regulators so that we can have a consistent effort internally, right? So that we don't have to provide portfolio managers with 2 different reports, right? One for the European funds and one for the US funds that hold very similar securities. We do that in a consistent basis, both to simplify interpretation and to simplify ease of implementation. I think those are really my highlights. I have another one. There's a proposed rule on derivatives, but let's not dwell on that. It's a very similar story, actually, in terms of the rule being quite prescriptive and us working on a comment letter and then beefing up our infrastructure to have the right data and analytics to provide good insights into derivative usage and what the derivatives are doing to portfolios and what risks they may be introducing or mitigating and how we can adequately risk manage that and also make sure that we provide the board good insights into that. One interesting topic that comes up here that might be worth discussing later on is the role of the board. So, I think the industry has a little tension right now where there's a wrestling to figure out whether the board of directors should be involved in overseeing the management company, right, and the way that we go about things, right? So they should oversee our risk management approach and the way that we take care of things, right, as the ultimate governance body, or should they get into the data? Dig one level deeper and get into all the information about the money funds and the fixed income funds and their liquidity risk profiles and their cybersecurity capability and their derivatives usage. And so, I don't think the industry has really figured that one out yet, but I think it's an important topic because the risk of getting the board involved in understanding all the analytics and very sort of complex and interesting ideas is that it might take their eye off the ball from a more kind of higher level important governance perspective. But again, all interesting conversations to have. So thank you again. I appreciate the chance to be here.